you've been a big proponent of what are they called? Factor? What are those? The
The
names?
buffer ETFs?
Yes, the buffered ETFs. Can you explain again how these work and what they might have done in the last couple weeks?
Sure. What is
And
interesting about buffer?
we're seeing a pretty big increase in the use of these today versus 5 years ago.
Yeah, and this is something that we've used in client portfolios ever since really they became available. And what really helps is that if you know that, okay, I have some of my investments in these buffer ETFs, and what they're designed to do is that over a 12-month period, they insulate against a certain amount of downside. So we target 15% downside. So for instance, if you're invested in in a buffer ETF, that typically they're looking out over a 12-month period. If from the beginning of that period to the end of that period, the stock market is down 15%, then that buffer ETF is just going to be break even because it's designed to soak up 15% of loss. But if the market does really well and goes up, it's designed to participate in that upside point for point up to a cap. So what's great about these is it helps keep people invested because they know
and the lower the drawdown before you start having some losses, the lower the cap, right?
Right. So they make flavors that
like
have
insurance.
100% downside protection, but your upside cap is going to be
about the same as
6,
treasuries.
7%.
Yeah.
Right, exactly. But with the 15% downside, our caps are anywhere from 12, 14, 15%. And that's looking pretty attractive over a 12-month period, especially when we look at typically the market isn't down more than 15% in a 12-month period.
Yeah, and it's when you're looking at something like that, a buffered ETF, you're not recommending someone put all their, that's their whole portfolio, right?
No, not at all. Not at all. 20, maybe 30%, just to help insulate against that risk and diversify a little bit.
And with that, does it enable somebody to take a greater equity have greater equity exposure? So let's say they typically would have a 50% allocation or 70% allocation towards equities. By using a strategy like this, because of that downside protection, does it enable you to have greater equity participation?
It does, because it's completely correlated to equities because that's what it's buffering against. And it participates in that upside 1 for 1 until the cap. But you know that you have that downside protection if things go sideways or go down in this case. So yes, it allows you to take a little bit more equity exposure without increasing your risk.
And when you look at the example you give, this buffered ETF that up until 15% decline, you're break even. When it goes below 15%, you start having some loss. So if someone put in $100,000 on January 1st and the market had declined 14%, is it basically still the value of $100,000? Like, what kind of volatility do you experience until it goes out of those caps or the downside protections?
Great question. Within that,
because the reality is, people look at their portfolio values on a daily basis. They don't always, but sometimes they do, or they look at the monthly statement or the quarterly statement or whatever. And if there's ups and downs, they tend to think about how much, and how much labor it took them to, I just lost whatever the number is, $400,000. My gosh, I was making $100,000 a year. That's 4 years worth of my labor or whatever it is.
Right. And so something that's interesting to note is that pretty much everything you own fluctuates in value every day. You just don't have access to what it's worth on every particular day. Same for if you own a CD at a bank. It fluctuates in value on a daily basis. You just can't see it. You're just assuming I'm going to hold this thing until it matures, and I know what I'm going to get at the end of that maturity. Same kind of thing with a buffer ETF, except that now you can see how it moves every single day. So yeah, within that 12-month period, it's going to go up and down along with the market. But if you hold it to the end of that outcome period, then it's going to soak up that 15% of downside. So that's why I tell my clients the intent is to hold this for 12 months. Now, you can sell it early, and frequently we do. If the market's doing really well and that buffer ETF is close to its cap and it's only 6 months in, well, it makes sense to sell that and go into a fresh buffer ETF. But in periods where the market's volatile, you know that, if worse comes to worse and 12 months from now the market's still down 15%, then these buffer ETFs are going to soak up that loss.
Yeah, and I wouldn't really recommend that someone reallocate towards these right now just to minimize some losses, and maybe some small portion if they're very nervous, because the downside, of course, is the limits you have on the upside, and markets move really quickly, right?
Yeah,
and you just talked about like the year after the COVID low and how much the markets moved up, and you don't want to participate in the downswing and then not participate in the recovery.
That's right. It's good to add these to your portfolio before the market is down 15%, because you want to participate fully in that recovery. You're absolutely right.
Yeah.